Over the last year, artificial intelligence has sparked an amazing and unexpected stock market boom that may soon go bust. The S&P 500 is being propped up by the Magnificent Seven tech stocks that are pushing the market to new heights. But experts are advising caution as conditions take on an eerie resemblance to the dot-com boom of the 1990s. And the problem that we see is that there's an irrational exuberance overinflating today's stock prices, which could suddenly be squashed by the slightest change in economic sentiment. Think sudden crash, massive losses, and a lingering recession that could cut the market in half and cause the market to trade sideways for the rest of the 2020s. Now, the stock market bottomed out last October and it's been rising ever since. Tech stocks are leading the way, specifically a group known as the Magnificent Seven. This includes Amazon, Apple, Meta, Alphabet, Tesla, Nvidia, and Microsoft. Bank of America has called the AI boom a baby bubble with returns on trades rising beyond 200%. But the concentration in this market is nearing its highest level since the dot-com days, and there's actually less diversity of companies leading the market in 2024 than at the peak of the dot-com bubble. And this is a very dangerous recipe coupled with a growing recession fear, out-of-control government debt, and consumer spending that's drying up. Ed Yardeni is a longtime investment strategist and president of the well-respected Yardeni Research, and he's saying that instead of a repeat of the inflationary 1970s or a replay of the productivity-led boom of the 1920s, the current decade has the potential to play out like the tech-led stock market party of the 1990s. The rapid rise of AI chipmaker Nvidia is looking very similar like the parabolic ascent we saw with Cisco, which was the maker of internet equipment. Cisco's share prices increased 8 times from 1997 to March of 2000. Nvidia is up over 250% with the AI explosion ignited by ChatGPT. And the Fed may have inadvertently swelled the bubble by pausing rate hikes this year, and they're going to make it much worse if they begin cutting interest rates later this year as well. Lower rates could fuel an even higher irrationality for investors with newly accessible cash overinflating the asset prices. John Wolfenberger is the founder of bullandbearprofits.com and a former investment banker at JP Morgan and Merrill Lynch. And he's comparing today's market to the dot-com bubble of the 90s, issuing a very stark warning. And he says, for those of you younger than us who did not live through the tech bubble of the late 1990s, you're now living through tech bubble 2.0. And as a reminder, the NASDAQ fell about 80% when that bubble burst in the mild recession of the early 2000s. Given the fact that stock market valuations are even higher now than they were at the tech bubble peak of 2000, we wouldn't be surprised to see a similar decline in the coming recession. And there's plenty of evidence supporting the idea that this is a bubble. The Shiller price-to-earnings ratio gauges whether the market is overvalued, and it's screaming at investors that currently it's at one of the most elevated levels in history. In fact, it's even higher than it was in 1929. Now, the concentration of stocks into the Magnificent Seven also points to a bubble. In fact, the top 5 stocks make up the highest percentage of the S&P 500 than they did in the dot-com bubble. This drastically increases the vulnerability of the market to crash if anything happens to those leaders. Wolfenberger identifies several factors pointing to the impending bubble-bursting recession. Despite the touted good employment numbers, there's a continued sharp decline in the number of full-time employees in America. The drop is quickly resembling unemployment rates seen just before the recession of 2001 and 2008. Manufacturing data is also declining, which fuels further unemployment, and then we have the inverted Treasury yield curve, which always signals a recession. And there are many expert voices sounding the alarm. We have legendary investor Jeremy Grantham, who correctly called the 2000-2008 crashes and said that stocks are currently in a super bubble. Adam Carr, president of Orbis Investment Management, issued a warning that historically similar periods have ended very badly. Expensive stocks lost 40% of their value following the Japan bubble in the late 1980s and 50% of their value following the dot-com implosion. Investors can look foolish for not owning the winners in the short term, and FOMO can be incredibly overwhelming, but paying too much for an asset with high expectations can be a recipe for disaster. And JP Morgan is strongly advising caution in this economic climate. A team of their top analysts found that the rising concentration in the stock market has become an important risk for investors, and they should be aware of this in 2024. They believe that the Magnificent Seven are overdue for a period where they lag behind the broader market, and they warn that clients need to expect a serious drop in the market as a result. And so with the AI boom driving the market higher and taking on an uncanny resemblance to the dot-com bubble of the late 1990s, where many stocks lost 80% of their value, investors really need to be on guard and looking for ways to protect their portfolios. It's very easy to get caught up in the excitement of quick profits, but the bigger that bubble grows, the harder the stocks will fall. And people with long-term outlook really need to investigate assets that will weather the inevitable market drop and protect their portfolio from losses. And so if you're concerned about what you're seeing in the economy, I'm Makai Block with American Hartford Gold. Give us a call today and we'll discuss how adding physical precious metals to your portfolio can give you the hedge that you're looking for.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.